In 2020, a Swiss bank earned about $17.5 million from one client. Within a year, that client cost it $5.5 billion, $17 million in. $5.5 billion out. Same client, same year. He wasn't a bank, he wasn't a hedge fund. He managed no outside money, filed almost nothing, and appeared on no list of major shareholders anywhere in the world. 9 of the largest banks on earth were lending to him at the same time. Not one of them could see what the other 8 were holding. 2 years after he defaulted, that Swiss bank no longer existed. His name is Sung Kuk Hwang. In New York, he went by Bill. He came up inside the most successful lineage in modern investing. Julian Robertson's Tiger Management produced a generation of managers who went out and started their own funds. They were called the Tiger Cubs, and being one was a credential you could not buy. In 2001, with Robertson's money behind him, Hwang launched Tiger Asia. He was good. For most of a decade, he was very good. Then, in December 2012, Tiger Asia Management pleaded guilty in a federal courtroom in Newark to 1 count of wire fraud connected to short-selling Chinese bank stocks. The firm forfeited more than $16 million and was sentenced to a year of probation. Note the wording. The firm pleaded guilty. Hwang entered that plea on the firm's behalf. He personally settled separate civil charges with the SEC for $44 million, without admitting or denying them. So, here's the first thing that doesn't add up. A man walks out of that year with a plea, a settlement, and a fund that has to give its investors their money back. And within months, the largest banks in the world are competing to lend to him again, because he had done something clever. In early 2013, he converted what was left of Tiger Asia into a family office and renamed it Archegos. A family office manages one family's money, and because it takes no outside investors, it sits outside most of the disclosure rules that apply to everyone else. No public filings of positions, no quarterly report of what you own, nothing for a journalist to read, and nothing for a rival to copy. For 7 years, it stayed quiet. Then came March 2020. From an apartment in Manhattan, as the pandemic emptied the city around him, Hwang began buying. Not many names. A handful. Media companies. Chinese technology stocks. Concentrated, aggressive, and completely unseen. In March 2020, the firm was worth around $1.5 billion, controlling about $10 billion in market exposure. 12 months later, it was worth more than $36 billion, controlling roughly $160 billion. That is not a return. Nothing in public markets does that. So the question isn't how he picked the stocks, it's how he was allowed to hold them. Here is the piece almost every telling of this story skips. Archegos, for the most part, did not buy shares. It used something called a total return swap. The mechanics are simple, and they matter, so stay with this. Archegos would go to a bank and say, "Buy me $100 million of that stock." The bank buys it. The bank holds it. The bank's name is on it. Legally, the bank owns it. And then a contract says if the stock goes up, the bank pays Archegos the gain. If it goes down, Archegos pays the bank the loss. Economically, Hwang owned the position. On paper, he owned nothing at all, which means when regulators required large shareholders to declare themselves, Archegos had nothing to declare. It became one of the largest holders of several public companies in America and never once appeared on the list. That's the first layer, invisible to the market. The second layer is what made it dangerous. He didn't use one bank, he used 9. Credit Suisse, Nomura, Morgan Stanley, UBS, Goldman Sachs, Deutsche Bank, Wells Fargo, and others. Each bank could see its own book. Each bank knew exactly what it held for him, and no bank could see any other bank's book because there was no mechanism anywhere that would have shown them. So each of the 9 believed it was holding a slice of a large, diversified portfolio. All 9 were holding the same handful of stocks. And when the banks asked, as they did repeatedly, They were told a portfolio that was not the real one. Prosecutors proved to a jury that Archegos lied to its lenders about what it held and how much cash it had in order to be granted more borrowing capacity and to talk those lenders out of selling when they got nervous. The firm's own head of risk later admitted to doing exactly that. Now, the third layer. This is the engine. Every dollar of new borrowing capacity was spent buying more of the same small group of stocks. And buying a stock in enormous size does something to it. It pushes it up. A higher price meant the portfolio was worth more. A portfolio worth more meant more collateral. More collateral meant the banks extended more capacity, and that capacity was spent buying more of the same stocks, which pushed them up again. Look at what that is. The output of the machine is its own fuel. The price he was borrowing against was a price he was setting. Picture a man bidding at 9 separate auction houses on the same painting. Every bid he places raises the painting's price. Every auctioneer, seeing the new price, values his collateral higher and lends him more. Each one is certain he's buying one painting. He is buying the same painting 9 times. And he is the reason it keeps going up. It works. It works beautifully. It works right up until someone else in the room wants to sell. And you might still be thinking this is just a very large bet that went wrong, that a man got greedy with leverage and the market moved against him. So let me tell you what he did on March 23, 2021, with the stock already falling, with the margin calls already coming. He bought almost $1 billion more of it, not to profit, not because he thought it was cheap. Prosecutors proved, and a jury agreed, that he did it to hold the price up, which tells you what the previous 12 months had actually been. Everything the banks needed was already in front of them. Start with the record. This was a man whose previous firm had pleaded guilty to wire fraud less than a decade earlier. That is not a rumor you have to dig for. It is a public court docket. Then look inside Credit Suisse, which lent him more than anyone. By September 2020, Archegos' holdings there had climbed past $9 billion, and the bank's own internal credit rating for him was downgraded because its risk models said the positions were taking too long to imagine selling. In February 2021, the bank demanded $750 million in additional margin. Archegos sent $500 million. The bank accepted it. Then, on March 12, 2021, 14 days before the default, Credit Suisse renewed $13 billion of his positions for another 2 years, most of them at the same thin margin terms it had always given him. The bank's own post-mortem later found that renewal had been agreed by mistake. Here is the number that should have stopped all of it. Against that exposure, Credit Suisse's revenue from the relationship in 2020 was roughly $17.5 million. Any first-year analyst could have run that division and asked the obvious question. Nobody did. And the other banks weren't blind either. Goldman Sachs ran him at substantially more conservative leverage than Credit Suisse did, which means at least one lender had priced the risk correctly, and the others could see they were on different terms and never asked why. But the deepest tell isn't a person who was ignored. It's an absence. In most collapse stories, there's a whistleblower, someone who saw it, said it, and got overruled. Here, largely, there wasn't one. Not because people were silenced, but because nobody's job was to look at the whole thing. No regulator was assigned to aggregate his positions. No bank was permitted to see another's. The structure had a hole in it exactly the shape of what he was doing, and he sat in that hole for a year. Then a media company decided to sell some stock. Monday, March 22, 2021. ViacomCBS announces it will sell $3 billion of new shares. From the company's side, it's ordinary. The stock had risen more than 160% that year, closing above $100. Management saw a high price and moved to raise money at it. Almost none of them understood why the price was high. ViacomCBS was Archegos' single largest position. That day, it fell about 7%. Tuesday, March 23rd. Hwang directs the purchase of nearly $1 billion more. ViacomCBS and the other names he'd been holding up. trying to stop the slide. It doesn't stop. Wednesday, March 24th. The offering prices badly. 20 million shares at $85, well below where the stock had been trading. The market's answer is immediate. ViacomCBS falls roughly another 30%. Tencent Music falls 20%, and now the loop runs backwards. Lower prices mean less collateral. Less collateral means the banks want cash today. Credit Suisse alone calculates it needs $2.7 billion from him the following morning. That evening, Archegos tells Credit Suisse something it has never had to say. It cannot meet that call, and it cannot meet any of the others either. At which point, the senior executives of Credit Suisse are informed of the existence of a client several of them had never heard of. Thursday, March 25th. The banks now understand for the first time that they are all holding the same stocks, and that all of them are about to sell into each other. That night, the first blocks move. Billions of dollars of Archegos positions are unloaded in private trades before any of this becomes public. Investors would later allege in civil suits that certain banks sold while holding information the market didn't have. Those claims have been contested, and the courts are still working through them. Friday, March 26th. Credit Suisse issues a formal termination notice, and that morning it discovers Goldman is already in the market, selling. There is no orderly way out. Credit Suisse, Nomura, and UBS want a managed liquidation. Everyone selling slowly, in coordination. Deutsche Bank, Morgan Stanley, and Goldman decline. The banks that ran survived. The banks that tried to be orderly were the ones still holding stock when the price found the floor. ViacomCBS, sold to the public days earlier at $85 a share, traded near $48. It took less than a week. $20 billion of one man's wealth gone. The bill arrived in pieces. Credit Suisse, $5.5 billion. Nomura, about $2.9 billion. Morgan Stanley, $911 million. UBS, $774 million. Mitsubishi UFJ, roughly $300 million. More than $10 billion on a client nobody could see. Regulators in 3 countries eventually issued a coordinated penalty of $387 million over the failures at Credit Suisse. Credit Suisse did not recover. It was not Archegos alone. A separate collapse and a long run on deposits belong in the sentence too. But in March 2023, a 167-year-old bank was absorbed by its rival across the street. In April 2022, Hwang was indicted. His head trader and his chief risk officer had already pleaded guilty and agreed to testify against him. In July 2024, after a 9-week trial in Manhattan, a jury convicted Bill Hwang of racketeering conspiracy, securities fraud, wire fraud, and 6 counts of market manipulation. In November, he was sentenced to 18 years. A sentence the judge said reflected losses larger than any he had dealt with. His chief financial officer got 8. His head trader, who cooperated and told the court he felt deep remorse, got no prison at all. So that's the ending. Except it isn't. Because as of last year, Bill Hwang had not served a day of those 18 years. He is free on bail while he appeals. And he has filed an application for a presidential pardon. This is the archetype we call the system that ate its owner. Not a fake company, not a stolen deposit. Every stock was real. Every dollar he put in was his own. What he built was a structure designed so that no one could see the whole. And it worked. It worked so completely that when the price finally turned, he couldn't see the whole either. There was no edge to find, because he had spent a year erasing it. 3 numbers, and I'll leave them next to each other. The banks lost more than $10 billion. His lawyers told the court his personal net worth had fallen to at most $55 million, and his charitable foundation, a separate legal entity, reportedly still held well over $700 million. And before you decide this has nothing to do with you, every margin account works the way his did. What you own sets what you're allowed to borrow. So the price going up hands you the money to push it up further. That's not a loophole. That's the design. He had one thing more than you do. 9 lenders who couldn't see each other. He never took the stand. So no one ever asked him the only question that matters. Whether he knew the price was his own, or whether, right up until the last morning, he believed it.